tell you if you enter here, you put your stop loss down here at the swing low. Okay, and nothing wrong with that. It works for a great many people. I just don't like spending that much money on a trade. Okay, if I can buy the same trade, if I can go after the same target and spend less money to get there, that's what I choose to do. So how we do this here in this room is we go down to a 1 minute chart. And now let me find that. Let me go back. I just want to find that spot. And there's a lot of 1 minute candles. I should have looked at the time on it. I want to go back to that trend line. Here it is, right here. Okay. So now this is the trend line from the 15-minute chart. Do you understand? Understand that, CC and Kahan? Do you guys understand? This is the pullback trend line from the 15-minute chart. So now what I wanted to do was take a trade on the break, on a close above this trend line on a 1 minute chart, which is what we did. All right. And then I went back here and my stop loss was 6 pips. I rounded it out to 10. And then we took the same trade with the same 60 pip take profit. But instead of using a 50 pip stop, which is what a lot of the books would have told you, instead of using the 50 pip stop, I used the 10 pip stop. And I don't know if you saw the chart that was posted this morning. That trade played out completely. All right. Do you follow that, CC and Ken and Kahar? And let me just hang on a second, because I don't know if you saw any of this stuff. Let me just see if I have the right page available. Let me go back. Just give me a second here. I'm just doing a little stuff on the computer here, just so I can show you the picture, because I followed the trade through. Okay, and this is pound dollar 15-minute. All right, just give me a second, and I'll bring that up so you can see it. Let me slide this over. View, sort by. Yep. Okay. Now, as you can see, this is that same area. You see the trend line here? Ken, Kahan, and CC? I just want you to see that this is the same chart. Okay? You see it's the same chart here. Here's the trend line. There's the trend line. And you see we had this white candle moved up. Now, what I did was I monitored the trade overnight. And at 7:48 last night, the trade was up 50 pips. Okay? And then when it was up 50 pips, I moved my stop loss all the way up to lock in 30 pips. So if the trade came back and hit the stop loss, I got paid for a change instead of me, paying them. Okay? And, excuse me, the trade eventually hit its 60 pip target. And early on in the trade, if you look at our trade log down here, early on in the trade, I split the trade when it was up about 15 pips in profit. And then I let the runner go. The half a lot, you see the half a lot there? All right. So this is how, I try to teach basically just naked trading, just trading with only the candles on the chart, candles and straight lines. Indicators are very, very powerful when you use them in the right situations. And down the road, when we start working on indicators, you'll see where their power really comes in. Okay. It's been my experience, most traders were not taught about indicators properly the first time. And because of that, they make the same mistakes over and over, not knowing that they're mistakes. All right. Brian, did we okay, Khan is saying you are not conform, you are not be conform indication. I'm not sure what that means. He's asking me something, and the way he's asking it, I am not BC. What? I am not. Okay, we may have a language situation. I am not BC. You are best trading information share. I'm trying to understand what you're saying, Kahan, and I'm not picking up on it. But I just want to go back and Brian, did I cover that thoroughly enough for you? And is there anyone else that needs me to go over how this trade was set up? This was this was a combination of two different things. We had the bull flag, but there was no way into the trade. At the time, we were looking at the chart, and then this pullback showed up, and then we went to a 1 minute chart, and we entered the trade there. All right, and Khan and I think Jose asked a question earlier, but as you guys see, as you type, everything like the menu keeps moving up. Okay, please confirm information not told. This information, this information is all old. Yeah, there's nothing new in Forex. There's nothing new in candles. What I find is that people don't learn it properly. That's the biggest issue. And are you making money right now? That's what this is about. If you are making money, then continue doing what you're doing. If you're not making money, this may be a good place for you to sit for a few days to pick up some tips. Okay? And CC Khan is key. Oh, I have no idea what these guys are talking about now. I'm assuming, is that Indonesian CCC? Well, Jose, yeah, generally a good entry point from the flag in most cases is the breakout of the flag. And most flag patterns you can trade on the native chart, meaning on the chart the flag was formed on, because you've got pretty much a really good risk-reward ratio in the length of the flag pole. All right? And if you look at the length of the flag pole, and if you look at the width of the channel is only 10 pips, and if the flag pole is 60, even if you enter here and put your stop in the flag itself, you're still looking at a risk reward of 3 to 4 or 3 or 4 or 5 to 1. All right? So on the native chart, generally the best entry would be a break above that flag. All right, Jose? But again, you know, I prefer to try to take the same trade as with the least amount of risk. My whole thing is controlling risk, because the only thing that you can control in a trade is risk. Well, Jay, if you check your email, I sent you the answer sheet to that quiz. If you check your email, when you take that trader quiz, you come up with a number, and then after you come up with the number, I send you the answer sheet. Oh, you said, oh, well, I sent the wrong sheet. Okay, I'll take care of that after the Okay. Oh, so you got 2 score sheets. All right, I'll send you the answer sheet after the class is over. I was handling a lot of emails, and I may have had a brain fart. Okay. All right. So I assume we're pretty covered on this with the flags. Now we're going to go over a lot of this again tomorrow, Because remember, Friday I try to concentrate on the new guys, and a lot of it is review. So if you guys don't want to sit through the review, I get that and I understand it, and we can take we can go back over it again. All right. Now, what I wanted to start in today, okay, someone is saying, Calzone is saying Euro 15 minute. Okay. We'll come back to that in a bit. So what I want to talk about now, we learned a few different things here over the last couple of weeks. Okay. We covered we covered sniper trading, okay? And what sniper trading is looking out on a 1 hour or looking out on any higher time frame. Oh boy, I have a lot of lines on the chart. Sniper trading is looking out on any higher time frame and then going to a lower time frame to take the trade. All right? And this saves you a lot of risk, and it'll keep your risk down. Okay, Jose, I'll send you the test also after the class. All right. So a quick example of a we learned sniper trading, which is going down to a lower time frame to minimize your risk. Number one. Number two, we learned the price trap trade, and the price trap trade is a 3-candle formation. Here you have one candle, and it's followed by 2 candles, and neither of the next 2 candles could close above this high or close below this low. All right? Neither of the next 2 candles. So that becomes a trade where we would box that out, and I'll just draw a line across the top, line across the bottom. Okay, and then we look for a breakout of this trade. We look for a breakout of this box. And again, it's a 3-candle formation. You have to have all 3 candles working in conjunction. All right. The next thing that we learned, okay, were pullback trades. All right. And on pullback trades, what we're doing is we're looking at the natural movement of the market, and we're trying to take advantage of that. So, let's see here. Here we have we've got a downtrend here. Not quite enough candles, but when we get the next highest high, when the high of this candle does not penetrate this low, that's a signal that we could be in the middle of a pullback. And then what we would do is we would mark it like this, and then we would look to trade either the break of the pullback or 1 tick below the low of the most recent higher low, or 1 tick below the low of the original candle. All right. So we have the pullback, we have the sniper trade. Now the pullback trade is predicated on the fact that the market moves in rhythmic patterns. All right. And here is a second pullback trade here. There's actually another pullback trade here. Okay. And this is another way of getting into a trade, catching a trend, and getting into the trend at a better price. We also learned about channel consolidation. I'll do the wedge because there's a wedge up here anyway. We also learned that another form of consolidation is a wedge. And most wedges are formed when price cannot make a new high and price cannot make a new low. When price can't make a new high and price can't make a new low, we end up with a wedge. And you see that it's another form of consolidation, the wedge, okay? No one's making money in here. And you see, if you look at the largest candle in the back of the wedge, when you break down the DNA of a wedge and how price reacts in a wedge, None of the other candles in the wedge will be as large as the largest candle at the back of the wedge. And as we get closer to the apex of the wedge, you'll see that the candles tend to get smaller and smaller and smaller. And then again, we're looking for a breakout, a close above or below the wedge, preferably in the direction of the trend or in the direction of the new trend if we have a confirmed change of trend in the market. Our take profit on the wedge will be equal to the back of the wedge. Okay? And as you can see, this particular wedge played out pretty easily. All right? The other thing that we discussed was sideways consolidation in a range-bound market or angular consolidation in a range-bound market. So here we have a range here. And here. And if you remember, as we just talked about earlier, when you look at the this range, price moves in a triangular fashion to create this range-bound market. And once you spot the first triangle, you can set yourself up to take advantage of all the others. But the key is in spotting the first triangle. Once you spot the first one, the rest of them are yours to trade with. Okay? Touching on that. So, the other thing that we learned in the 4 building blocks of price action were the names of the 4 building blocks. And the first one is the uptrend. Second one is the downtrend. All right. The third one is the consolidating or sideways market. Why is that not drawing? The third one is the, something's wrong. Third one is the sideways or consolidating market, and it's still not drawing for some reason. Am I going too fast? Oh, that's weird. Okay, I'm not sure why that's going on like that. Okay, I'm looking at the questions. Oh, what's going on here? Okay, Khan is okay, Khan apparently has some issues. Yeah, Khan has issues of some sort. Okay, and I'm going back over the chat. I'm trying to scroll down. I didn't realize all this was going on. Yeah, Khan is, I don't know who he is. He's obviously from another country. And sometimes he writes in his native tongue. And I've done this long enough to know that every now and then you're going to get somebody that whose psychology doesn't quite fit the psychology of the room. Okay? So I don't want to say anything negative about him. I'm just going to say his psychology is not conducive to the psychology in the room. Most of the people in this room, Khan and CCC, are actually trying to learn how to improve what they do in their trading. And I can see, by some of your comments that maybe this is not the best place for you. All right? And not because you are making comments, but your comments don't directly lead to improvement. Do you understand what I'm saying, Kahan? So, I wish you luck, but I would, rather than waste the time banning him, the simplest thing to do is simply ignore him. And he can either learn or leave. But don't respond to anything he says. Okay, until we understand what his issue is. That's the best way to handle it. All right, I have no idea who he is. Just ignore him. No, he's not. He's not hogging the chat room, Sean. Listen carefully to this. He's not hogging the chat room. You are paying rent in his condo of confusion because every time he types something, the rest of the room has a need to respond. So if you don't respond, he will get no attention, and if he doesn't get the attention he wants, he'll leave. If he's interested in learning, we are all here to help each other. Okay? If he's interested in chaos, this is not the place for him. And I wish him well. I got nothing against him, but I've seen his type before. All right? So, don't pay any rent to his nonsense. And I don't mean, that he's a nonsensical person, but just ignore him. Okay? And eventually he'll get tired and he'll either decide to learn or he'll decide to leave. But those are the two basic choices. And he's not the first one. We will see other guys like him. Okay? So let's just move on. Now, for some reason, I can't draw a box unless I made my boxes the same damn colors. That's kind of funny. That's exactly what happened. The box is the same color as the room. Okay, here we go. All right. So that's why I couldn't see the boxes. So the four building blocks of price action is the uptrend, the downtrend, the sideways or consolidating market, and the instant reversal. Okay, where one candle changes the entire direction of the market. All right. When we turn the chart on, the first thing we're looking for is we'd like to know where are we in these four building blocks? Which of these four building blocks is current price in? And once we understand which of these four current block, once we understand which of these four building blocks we're in, we can then ask ourselves, how do we handle it? How do we trade it? Is this in my trading plan? All right. So what I'm going to do is I'm going to ask Manuel to give me a pair, and I will ask Brian to give me a time frame. Okay, so Manuel is saying the EJ, Euro Yen. I thought I fixed these yesterday. They must have gone back. Okay, so Euro Yen, and time frame for Brian is 4 hour. Okay, so here we are, Euro Yen 4 hour. So now, as we turn this on right now, where are we in those four building blocks? Okay, if you look at the last 8-10 candles, where are we in these four building blocks? Okay, now Brian is correct, and Tony is correct, Calzone 2 is correct, John is correct. So it is a form of consolidation, absolutely. We do also have a wedge. Let me just bring this over. It is a form of consolidation. We do have a wedge. Let's look at the wedge. This is where the wedge would be drawn. That's the wedge. This is the consolidation right in here. Okay. And this is also a price trap. Let me get rid of the wedge here. This is also a price trap. As you can see, this is the high, this is the low, and none of these 4 hour candles, none of them have been able to close above this high or close below that low. So now that we know where we are, now our next question is, how do we trade this? How do we turn this into money? And this comes back to something I mentioned many times. Pick the method that you feel the most comfortable with. It could be my method, it could be your method. But pick one that you feel the most comfortable with now that you know where you are. If you're most comfortable with the price trap, then set it up for a price trap trade. If you're more comfortable with the wedge, set it up for a wedge trade. Gene is asking, Lou, do we calculate with the back of the wedge? If you're going to, Gene is saying, do we calculate it with the back of the wedge? Gene, if you're going to trade the wedge, then yes, you set it up on the back of the wedge. You got me? You try to go by the last touch. Now this is kind of way out there, all right? And we don't have another candle down here anywhere. So I would come into this general area. All right, we don't have a candle out here for the back of the wedge. So this is what I would calculate as the back of the wedge here, 138 pips. All right. Do you understand that, Gene? I don't have a touch down here that I can get into. So I'm going back to the last dominant candle in the wedge. And remember, all wedges are going to have one dominant candle that's going to be larger than every other candle after it, and that's this candle. All right.
Lou, may I say something?
Okay, someone's trying to speak.
Lou, can you hear me?
Yeah, go ahead.
That's me, it's Gene.
Yeah, Gene.
The only thing I was trying to do here, can you hear me now?
Yes, I can. I can hear you clearly.
The only thing I was trying to do here was recognize where I would set up my trade, and as of right now, being a newbie at this, as what you've explained, I would have calculated it on the long black candle that you just pointed at, not the beginning ones, but the long one, and calculated on a downtrend from there, 100 or 110 minus 10%, which would be, I don't know, 100 pips or 110, whatever it is. I'm not sure.
Right. Right. I would go to the top of the triangle, come down to the bottom of the triangle. It's about 130 pips.
Lou?
Okay, and then that's how I
lost you.
Yeah, Gene, you're still having some internet issues. Yeah, your voice is chopping up a bit.
Well, it's pouring here in South Beach, so maybe that's why.
Good for your ass. Was I
correct?
Does anyone else?
Was I correct?
Yes, you were absolutely correct. Okay, can everyone else hear Gene? Just want to make sure that they can hear him. Okay, great. So you understood. Remember when I mentioned wedges usually have a dominant candle, and no other candle after that dominant candle comes near the size of that big candle in a wedge. All right? So in this particular case, what we would do is measure from the top of the triangle down, and then use that as a projected take profit. Okay, whenever the wedge breaks out. Okay, whenever we get a close below here. All right, and my bias on this is short at the moment, only because this wedge formed after a legitimate uptrend. Okay, and how does price behave in an uptrend? Price goes up, pulls back. Then price goes up again, and you see we got legitimate pullbacks. Okay, and then price goes up one more time. And as you guys know, after the third one, I try not to chase for the fourth. That's, my own personal way of looking at it. Hey, Lou, the bear candle closed below previous swing low. What bear candle? Oh, I guess you're talking about this candle closed below this low. All right, well, I was going to get to that. This is now, Gene, could you kill your mic? All right. Okay, now, Rabinko is saying that I'm not using the high and low of this black candle, by the way, for my price trap. I'm using this candle as the high and low for my price trap. I want you to understand that, because sometimes when you get a large candle like this, it can engulf a great number of candles, and usually inside that there'll be another price trap. Do you follow that, Ravinko? And what I want to do is find the smaller price trap, because that keeps my risk in line. Look over here, Ravinko. You see this huge candle? Well, this huge candle actually trapped all of these. It trapped all of these. You see that? But I wouldn't use this candle for my price trap because it's so out of whack with the average size of the rest of the candles. However, inside this giant price trap candle, I have a smaller price trap that's a lot easier to manage. Is that clear, Ravenko? So I'm always looking for the most manageable situation on the chart. All right. Now, but the black candle bigger would be a. You saying, but the black candle would be a bearish setup? Uh, are you talking about this black candle? Yeah, the candle by itself is not a bearish setup the way we're doing this right now. Okay, when we get into individual candles and how to read what's in the wicks and how to read what's in the opening and closing prices, that will come into play. All right. Right now, the only thing we're looking for is price patterns that we've learned over the last couple of weeks and how to trade them when we see them. Okay, now Jay is saying, which is the signal of which direction is it going to go? What is the signal? Okay, there is no signal insofar as what direction it will go. All right, but what we look for is evidence. We look for chart-based evidence. Okay, we look for chart-based evidence. All right, and I'm going to show you that. All right, now, why am I saying this is short? Okay, that would be the next question. My bias on this is short. Okay, remember that when we have an uptrend, we go up, we pull back, we go up, we pull back, we go up. And remember, by going up, we're going higher than the prior high, higher than the prior high. We go up, we make a high. We go up, this is a higher than the prior high. All of a sudden, we have our pullback, we go up. This high is no longer higher than this one. So that's a clue that this uptrend is possibly over. Do you see that, J101? All right. The next thing is you have evidence that you're about to start a downtrend when the push down makes a new lower high right here. So this was the last lower high was right here. And all of a sudden, we now have closed below there. We've closed below that low. You see that? J101? Now that we've closed below this low, I have evidence here that's leading me to think that when this pin bar is done, this may push price down and make a close below this low. And now we're on a downtrend. Okay? All right, but the key here was we stopped making new highs. See right here, all this pushback could not make a new high. That's a good sign that this uptrend is over. And the fact that we're now making new lows compared to these lows. Now we need to see what's going to happen here because the market now is deciding whether or not it wants to go long again or short again. And that's why the market is in consolidation. Okay, so those that said consolidating market, you were right. Those that said wedge, you were right. Those that said price trap, you were right. Sometimes you'll see multiples in the same chart. But now the question now would be, how would you trade it? All right, which one of the three are you the most comfortable with? And then you can set up your trades that way. Okay? Everybody clear on that? Any questions on that? Okay, great. So now that we have this situation set up here, we can set up a number of different trade scenarios. We can trade for a break below this low on the price trap. And remember, in our price trap, our take profit is going to be twice the width of the box. Let's go here. That's 1. And that's 2. All right. And our stop loss is going to be the opposite side of the box if you're going to trade this on the naked chart. Okay. If you're going to trade this on the naked chart, then your take profit will be the back of the box. If you're going to do a sniper trade, your take profit will be somewhere near this breakout on the bottom. If we wanted to do this as a wedge play, Again, we will measure the back of the wedge. And this was good that you spotted this, Gene. Oh, wrong line. We will take a measurement from the back of the wedge, the largest dominant candle, and then we have to wait for the break of the wedge. Now, right now, ironically, this appears to be about the same no matter which way we play it. All right, you see that? Now, Jay is asking, what if it goes up? Okay, well, it didn't go up, Jay. You get what I'm saying? If it goes up, we're not going to take the trade anyway because we're only going to bias ourselves in the direction of the trend. That's one of those things I was talking about. A lot of people would see this, and if it broke up to the top, they'd instantly go long, and this thing may stall out on them, and then they're stuck. So if you remember from yesterday, this is about not taking the bad trade in the first place. So our bias is going to be short. Okay, and we've got a consecutive lower high now. We've got this high, now we've got a lower high. And remember, in a downtrend, we're likely to get a push down and yet another lower high. So that's why we're going to bias this short. The other thing that we're going to do is when I see this pin bar at the very top, I want to see what evidence do I have back in the past that tells me this might be a place where the market may drop. Okay? And if you remember how I particularly like to look at these support and resistance areas, I go to the last dominant close. And that would be right here, these two guys. That was the last dominant close. None of this whole cluster of candles could close above that close. You see that? Nothing in this last 20, 30 candles could close above there. I'm not too concerned how high the wick went, but I know nothing could close. And again, I emphasize close, 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 close. All right? Now that I have that dominant close, now I can mark the high. And then I can go back in the past and I can see, is there something in the past? What happened the last time we were in this area? So I'm going to scroll back a little bit. And you can see here, the last time we were in this area, here we broke through it, and then price came back, pulled back, and the last time we were in this area right here, we had a dramatic fall of over 300 pips. And then for a great length of time in 4-hour candles, we didn't come back here. And now we're back here again after this long break from that area. So the last time we were here, we had a dramatic drop down of 300 pips. We came back, hit that area again, made a pin bar, and now it has already started. It's already fallen 100 pips. And now here's the pullback, and there's possibly another 100 pip drop coming. So that's what I mean, J101, about chart-based evidence. All right, Gene is saying, Lou, the profit greater if the breakout is in the middle of the triangle rather than at the end. A breakout in the middle of a triangle could very often be a fake out in the middle of the triangle. Okay? And the other issue is, too, is on the, I'll talk about the triangle breakout in a second. I just want to finish this. I'll come back to that, Gene. I don't want to get off track here. So again, my bias is short because we can't make a new high. In order for this uptrend to continue, we have to have candles that close above this high. Is everybody, on board with that? Because every time we've made a high in this uptrend, we had a close above the old high. We had a close above the old high. Okay, you got it? We had a close above the old high. We had a close above the old high. And again, I repeat, so you can see this. So this is how an uptrend behaves. We don't have a close above this high now. And we've had a push down, and we've had our pullback, and no close above this high. So my belief is that this uptrend is over, and we may be in the midst of a downtrend. Okay, our job as a trader is not to guess. Okay, our job is to use as much logical evidence as possible, create a rule-based system, and stick with those rules come hell or high water. Okay? Any questions on that, particularly for the new guys? Khan, I see you posted something about a wolf break. What we're doing here, Khan, is we're only talking about price action. Price action in straight lines is all we're talking about. All right. Later on, we will get into Wolf and Gann and Fibonacci fans and the whole bit. But if you don't know price action, all the rest of it will just make you confused. All right. So again, we have a couple of scenarios here that we could trade. The object now is to pick the one you're the most comfortable with. All right. Now, if this should break long, all right, and this is something to keep in mind. If this breaks long, I have evidence on the chart to say if it does break long and goes up here, I have evidence to think that it's going to bounce off of this again. Because remember, when you get these strong areas like this, you usually get 2 or 3 attempts to break through to go back up again. So if it goes long, I'm not going to take that trade. You follow me? Because my bias is only short. Do you follow what I'm saying? I'm not going to take the trade if it breaks long. However, if it does get up here and decides it looks like it's going to turn short, then up here I would take a sniper trade short. Do you follow that? Gene, you're asking me where what, Gene? Gene is asking me where, but I don't know where what. The sniper trade short would be in this general area. And in other words, if this broke long, just to answer your question, okay, I'm not going to take a long trade on this setup. But I have evidence that last time we touched this area, it fell like a stone. We came back, it's falling again. If it comes back up here, it's worth taking a shot with a tiny stop loss in this area. So if these candles get in this pocket and it makes another pin bar, or if it goes above here 1 bar and comes back below 1 bar, then I'll come in and take a look at it. So I'm looking for something like this. Okay, but in here could be 2 or 3 candles. Do you understand that, Gene? Yeah, that would be a resistance trade. Okay, and again, it's just whatever method you like. You got it? Whatever method you like. But if this goes long, right off the bat, I won't be taking the long trade because my bias is short. So I can't get faked into that. All right, number 2, if it gets back in this area, my thinking is it's probably going to bounce again. All right, I could be wrong, but you need to have a bias on the chart. Now, the other thing, we didn't get into advanced chart patterns, but for those that are familiar, we also have here a head and shoulders. All right. I just want you to see, this would be the head. Oh, do I have to change this? Why did that paint that color? Oh, that's kind of weird. Okay, that would be the head. This would be one shoulder. And this would be the other shoulder. Does everyone see that? Remember, you have to think Picasso, not Norman Rockwell. Think Picasso. Okay? So we have a head and shoulders pattern. All right, let me clean up some of these lines. Okay, a head and shoulders pattern is a reversal pattern also. And when we do advanced patterns, I'll get into it. But since I started it, I'll just talk through the entries on this, okay? Generally, on a head and shoulders, what we're looking for is a break of this portion of it right here. We're looking for a break of the neckline. This is called the neckline of the head and shoulders. Some people would call this the neckline, but we've closed lower than that. All right? So a conservative entry would have been a break of the neckline. Okay, that's the most conservative entry. All right. A aggressive entry would be this trend line, and I'll explain why this is drawn when we get to advanced chart patterns. The aggressive entry would be here, a break of this trend line. Because once we make this and we believe that we're going to have a bit of a downtrend, and once this shoulder forms, this break right in here, that would be an aggressive entry, but we'll get to that. I don't want to touch on it too much at the moment. All right? So the idea is look at where you are on the chart, which one of the four building blocks, and then decide how you want to trade that. All right? So let's take a look at another pair. So we see now we can trade this as the wedge or the price trap. Everyone sees that? We have two ways of trading this. All right, and you know what? I'm going to walk through a trade just for everyone's sake here. Let's take the price trap trade. All right, I don't need the box tool. I'm going to mark this high. And again, remember, none of these candles closed. And remember, the closing price is key with most of these chart patterns. None of those candles could close above that high. None of those candles could close below that low. All right, my bias is short. So what I'm going to do is, I wanted to mark that line and I goofed up here. Let me see if I can slide this over. Okay. I am going to identify this line. Come on, cooperate. You guys know what I'm trying to do. I'm trying to mark the line and it won't. I want to give this line a name, and for some reason it keeps bringing up the other stuff. Anyway, what I want to do is I want to go short below this line. Okay, that's essentially what I'd be looking at. I'd be looking at a short below that line. So in this case, I'm on a 4 hour. I'll go down to a 15-minute. And on the 15-minute, that's my line. So now I know this line is from the 4 hour chart. Here we go. So I mark this line, and this would be the 4 hour okay, that's the 4 hour price trap low. So if I'm down on my 5-minute chart, just trying to trade in and out, make 8, 10, 12 pips here and there, this line is sitting on my chart. All right. If I don't remember what it is, I just go back to here. I go back to properties, and I know this is the 4 hour price trap low. You got me? So if I get a good signal underneath this line, I can take this trade and use my profit target from the 4 hour chart. So let's go back to the 4 hour chart. The width of this box is 60, let's say 65 pips. Okay. And I'll put a line, and I'll just, let's call it 65 pips. I go back to my 15, and you can go to even lower than a 15 if you want to. I'm going to go back to the 15, and what I'm looking for is an entire signal. Like I'm looking for a price to come down below here, maybe give a little pullback, and then go short. Okay, so then I could enter below here and put my stop right here. And if that were the case, I know there are no candles, but you get the idea. So what I'm looking at, I want to reduce this stop loss to an even smaller number, but I still want the profit target from the 4 hour chart. And that's the type of setup we did yesterday with that 10 pip stop and a 60 pip take profit. It's the type we did last Thursday where we had a 10 pip stop and a 75 pip take profit. All right, and the same thing we did with this, with the euro dollar and the other one. This was 25 pips, this was 15 pips, I believe. But the same premise where we took our take profit from a higher time frame, but we entered on the lower time frame. Is everybody good with that? Anyone have any questions, comments? If I went too fast? Okay. Gene is saying, Lou, I should always look at the lower time frames, even though working on a higher time frame. That's up to you, Gene. And it's also up to your risk profile. Some people can handle a lot of risk. They don't mind taking the trades on the native chart. All right. I prefer to be a smarter shopper. All right. And there are plenty of people that trade this stuff on the native chart and make plenty of money. So don't get me wrong. I'm not saying that they are wrong at all. I'm saying that their risk tolerance makes it easier for them to take those 50, 60 pip trades. Someone posted a Curry. You asked a question above, and I'm looking for the question. 1, 2, 3. You're saying on what chart, Curry? What chart were you speaking of? Curry is saying that there was a 1, 2, 3 setting. I just wanted to see where he is. EJ near the resistance on the 4-hour chart. I'm assuming, right? Okay. Oh yeah. So yeah, the other thing Curry is talking about, and again, I saw it, but I didn't want to talk about it because I don't want to add any other details to it. But since he brought it up, remember the other day we talked about another pattern called a 1, 2, 3 pattern, where this is point number 1, this is point number 2, and this is point number 3. After an uptrend, if you get a 1, 2, 3 pattern, that could be tradable also. And what you would do is you take your fib expansion tool, you would connect the 1 and the 2, and then connect that to the 3, and now you have a profit target built in here, a profit target built in here, and usually on mine, I also add an extra profit target at the 200 level. You see right here, this is fib expansion 1618. I usually put in a fib expansion at 200. So I can use that as a profit target also. All right. So yeah, that was there. But again, I don't want to add indicators to this at the moment, Curry. But the 1, 2, 3 is one of the methods that I like also. It's one of my favorites, especially after a trend change. All right. Yeah, Ken. They also can be price projections. All right. Yeah. Well, J101. Don't worry about the Fibonacci's. In a couple of weeks, we'll be going over Fibonacci. And we're going to touch on it when we do support and resistance also. So we'll come back to it. So don't worry about that. And then I'll be able to explain to you in a bit more detail. All right. So now let's someone give me a Jose, give me a time frame, please. And Medina, give me a pair. Jose, give me a time frame, please. Jose PTA. Okay, 15-minute time frame. And Medina, if you can hear me, give me what pair are we going to look at on the 15-minute chart? And I'm just waiting for Medina to respond. And again, for those of you that are new here, I don't handpick charts. I let you guys pick the time frame and everything, so you can't say I'm handpicking stuff out and picking the perfect situation. I just want you to see that what I'm teaching you is real and that it works. And there's nothing new in Forex. It's just how you put it together. All right. Medina, she started to type and then she stopped. Yeah, you're correct, Curry. Nothing new under the sun. It's what you do with it, how you handle it. And I'll give you a real good example of that. Okay, so Medina's saying Dollar Chef. Okay, so now I see you other guys are typing in pairs and stuff, but we'll go nuts bouncing all over the chart. And it's important to now it's important to stick with one concept at a time and move through it carefully. So we're going to look at Dollar Chef 15-minute, and we're going to ask ourselves, before I get there, the question we're going to ask ourselves is, where am I in the building blocks of price action? Which of the 4 building blocks of price action am I in? Okay? So that's what we're going to ask ourselves. All right. Which of the building blocks are we in based on what you see right now? All right. And I'm just waiting for guys to answer. Okay. Kimberly said wedge. Yeah, a bit one. Curry saying sideways consolidation, consolidation. Sean is saying wedge. Then he said no. Um, J101 is saying a channel. Okay. Very good that you spotted that, Jay. All right. Just want to see if there are any other answers. Brian is saying price trap. Yep. Consolidation, triangle, and price trap. Okay. But now the purpose in this is not about being right or wrong. It's about getting you to think differently about what you see on the market. Okay? You got that? It's about getting you to think differently. So now we are coming from a rather severe downtrend. Here we go. We are in a nice downtrend. All right? Now listen to me carefully. And I said this several times. In order for a downtrend to exist, you have to have a high, then you have to have a lower high, and then you have to have a lower high, and then you have to have a lower high. And for a downtrend, you have to have a low, and then you have to have a lower low, and then you have to have a lower low. And when I say lower low, I mean that after this low comes in, when the pullback is done, we close below here. And we did that on this candle. Remember that? We closed below here. Do you understand that? So now I'm down at this low. Prices pull back. Prices have continued down, but they have not yet closed below this low. I want you to see that. So I don't have any evidence that we're still in a downtrend. Okay, this is more evidence that the trend may change. Everybody see that? Remember, for this to continue a downtrend, this group of candles must close below here, not spike down and come back. All right, so everyone, very good eyes, very, very good eyes. All right, so now let's draw some of these out. This would be the wedge. All right, and you guys tell me if I'm not drawing it the way you see it. All right, this would be the wedge. And again, guys, for those that are new, the closing prices are the key prices for me. So I'd look at this block of prices right here. Nothing closed below here. So that's the real power of the bottom of this. Okay, so that's the wedge. All right. Someone else said they saw a channel, and I want to draw the channel. And remember, in order to get a channel, you want to catch that first triangle. Let me squeeze this down a little bit. You want to catch that first triangle. So here we have a triangle. You see that? I duplicate this to the top of the triangle. And now this thing could bounce around in here for a while. Do you see the triangular moves? And I'll just point them out. Is that the triangle you saw? I think it was Jose. Whoever saw this wedge, I mean this channel, is this what you saw as the channel? What I'm drawing? Okay, but that was very good eyes, very good eyes. So now I could take this trade short here now at the top of this with the assumption that it may come down here. It might spike down here. You got that? All right, so it's good that you saw that. Very good that you saw that. Now let me get rid of all this stuff. And we also have a price trap. And again, the idea is to get you to think differently about what you see on the chart. Don't change your trading method. If you've got a method that gets you into trades that you really like, stick with it. I'm just saying learn how to know where you are in the market so you can take advantage of what happens. Our